Real estate is getting unattainable for the younger generation. At the start of 2020, 75% of Belgian real estate was affordable for the average income. But now, only 2 years later, this rate has spectacularly dropped to 33% of the real estate market. How will this evolve further? Will we see a crash in the real estate market? Let's get right into it right after you hit the like button for the YouTube algorithm. Join me and the 1,660 members of the Money Network and let's grow together. In 2/3 of the Belgian cities, real estate is getting so expensive that families with an average income have to allocate more than 33% of their income to pay off their mortgages. And this is without taking into account all the costs for utilities, which are also very high at the moment. In Antwerp, prices are so high that on average people have to allocate 40% of their disposable income on rent or on mortgages. While in the Walloon area, this percentage is only 25%. After the extreme rush of the COVID pandemic in 2020 and 2021, the rise in real estate prices is finally starting to slow down. But due to higher and higher interest rates, getting a mortgage loan from the bank is harder than ever. People are forced to spend more and more of their disposable income towards a mortgage. And it's simply getting impossible. While banks and the government advise people to only spend or allocate 30% of their income towards housing, this has become increasingly more difficult. If you are forced to spend over 40 or even 50% of your disposable income on a mortgage, and on top of that you're stuck with sky-high utility bills, there is not much room to wiggle or basically not much money left to live off of. At that point it becomes unsustainable and even dangerous for people with an average income. And let's not even speak about people below the average income at that point. When you are looking for a loan, banks will allow you to spend up to 40% of your disposable income towards a mortgage. But often that won't even cut it nowadays. You'll have to present a large down payment before you even get a loan. And depending on your monthly wages, banks are a bit lenient here. But of course they are only lenient here if your wages are above average. And unfortunately not the other way around. The big banks ING, KBC, Belfius and BNP have all agreed that the real estate market will grow, it will continue over the next few years. On average, they expect a slight increase in prices. It is only on the nominal prices. In real prices, the real estate will lose value over the next few years. And this is because of inflation that will outperform the real estate market growth. Meaning that even though the actual prices of real estate are going up, real estate will eventually become more and more affordable. Furthermore, everyone agrees that an actual real estate crash is not bound to happen. Real estate prices in Belgium are still okay compared to the other European countries. Here, we can see that Belgian real estate actually started to slow down the last few years after the COVID rush, while in Germany and especially in the Netherlands, housing prices are growing exponentially. In these countries, caution is really advised. So how can you benefit from this evolution in the real estate market? It all comes down to the numbers. And let's start out with inflation. Today's inflation levels are around 10% for the Eurozone. That means that on average, over the span of 1 year, everything became 10% more expensive. Or in other words, your money lost 10% of its value over the last year. The inflation rate is boosted to the extreme by the rise in energy prices, with inflation levels of over 40%. But food also saw an inflation of over 10%. And personally, I expect this number to grow over the next coming months. Now, such inflation levels will eventually make wages follow. The average wage in Europe has grown 4.1% year over year, and some countries even raise their wages over 10%. For example, in Belgium, if you are part of the services sector, your wages will increase by 10.47% next January. If your wages do not increase or not enough, you can always look for another job where you will get more. Inflation is one big thing and increasing wages is the next one. But the next one after that are the interest rates that are imposed on us by the central banks. As you know, central banks raise their interest rates to combat inflation. And with the huge inflation levels at the moment, the interest rates are getting raised aggressively. The higher this central bank's inflation level, the higher your mortgage rates. But because at the moment in the USA, we can see a topping off of the inflation levels, and even it going down, the interest rate hikes might stop soon. Australia has decided to only increase their interest rates by 25 base points on October 4th, to the great surprise of the stock market. And this might be one of the first indicators that the interest rates go down again. Because Australia didn't raise their interests more than 25 base points, other countries and long-running bonds lowered their interests as well. So all these ideas considered, real estate will rise in nominal value over the next few years. It will take more euros to buy a real estate, but all in all, it will become cheaper to buy a property, since the real estate prices won't keep up with inflation. And good thing, the wages will, especially if you look for wage increases. At that point, real estate will become more affordable, or less overpriced, if you will. But as you know, when you are investing in real estate, the price of a property is less of importance. What's really the core idea of investing in real estate is cash flow. You're better off buying a way overpriced property with a good cash flow than buying a cheap property that has no cash flow at all. Cash flow keeps you in the game. Investing in real estate is really playing the long game. Your monthly mortgage payments won't go down over time. The inflation will slowly eat up this financial burden. On the other hand, rents will increase over time because they follow inflation. This makes the gap between your outflow and your inflow increasingly higher over time. So personally, I think it's still a very good market to buy real estate. You have to take a lot of things into consideration. The real estate being quite overpriced at the moment. Of course, the higher inflation and the increasing wages will make it more affordable. And of course, the interest rates will come down again in the next 6 months or the next 12 months. So maybe it's better to just wait a little bit longer, 6 to 12 months to buy your first property or buy a property whatsoever, because it's still correctly priced, but it might be a bit better in the next few months. So what do you think? Are you buying properties now, or are you just waiting for something to happen in the near future? Let us know in the comments below and share your knowledge with the rest of the Money Network. Thank you so much for watching, and until next time.